What's up, everybody? It's Joey Rockenstein. This is Rockin' Real Estate LA, the channel helping first-time and many-time homebuyers achieve their real estate goals through results that rock. On the show again, my leading mortgage expert, Natalia Benshaw from Prosperity Home Mortgage. Thanks for being on the show again. Hey.
Happy to be here. Thanks for having me, Joey.
Oh, I appreciate that. The mortgage mom you are.
Yes.
That's so. So on this video, we have been brainstorming some things that home buyers need to know. And it's when it comes down to it, it's the simple things. Like people need to know what these terms are that are thrown around in a mortgage. And so what better person to ask about this to explain some of these terms, what they mean, what they are, than you.
I would hope that I'm that person. So let's see how good I can describe all of that and get you guys armed with some mortgage terminology so that you become a mini mortgage maven when you're home shopping and loan shopping.
That's great. And you are that person because it says so on your business card. So that's why.
Yes.
So.
That's what they said when they made them. But all right. Well, I think what we should start with is like the obvious and that people forget is there. Everybody thinks about down payment, which is the money that you're going to make as a concession on the let me rewind that.
Okay.
It is your contribution to the deal. And it's the difference between the contract sales price and what the bank is going to loan you. They want to see that you have some skin in the game. You're not just borrowing 100% of what you're purchasing the home for and like, you know what, I don't feel like having this house anymore. I'm just going to walk away from it and let the loan go. A bank wants to see that you have some of your hard-earned money in the game. And the more of that hard-earned money you put in the game and the less you're borrowing, and we're going to touch on what that percentage LTV, loan to value, is in just a minute, you're going to get a better term on your loan, better interest rate, all that good stuff. So that's probably like the first and biggest thing to consider is how much money do you have to put down? It's not a horrible thing. Sorry.
So you mean this isn't free? Like the bank just doesn't give me all the money, and I have to put in money. What?
Nope. You have to have a job, and you have to have a little bit of skin in the game in most instances.
Interesting.
So, now, when you are a first-time home buyer, as we talked about on the previous video, there are some nice low down payment options, like 3 and 3.5% for your average consumer. There are some special perks if you are active or retired military through the VA loans like we touched on. And then there's some more specific programs out there too for like doctors or other types of heroes.
Right.
So.
Which is great. And I'll put a link to those videos too so people can refresh about that.
Cool. So I think the next obvious thing to talk about once we're talking about money and skin in the game and some of the costs associated with home ownership besides your down payment is closing costs. Everyone says, what are closing costs? I get that question a lot, and I understand how the idea can sound foreign if you've never bought a house. So
it does sound it's confusing that people don't understand that. I mean, people have to be paid to do their jobs, it seems like. So there are closing costs to pay, for the loan, for escrow, things like that. So that's great that you mentioned this because this is a confusing area of the whole home buying process.
Yeah, totally, Joy. It's not just about down payment. You have to take into account that even if you do a low down payment option, there's going to be other costs associated with the transaction. Even though we are all here to help and we have escrows like a neutral third party, we are all for-profit businesses, just like even a doctor or an attorney is. And there are a lot of legalities and places where we can even get snagged, advising and arranging loans and a transaction for you. So we have to be covered too in our professions. And it takes a lot of people to make one deal happen. So closing costs are your costs associated with the escrow company being your neutral third party between you and the seller and handling the exchange of all monies so that everything in your transaction down to the penny is accounted for. Us as the lender, we have hard costs associated with arranging a loan for you. It's not just, oh, we're going to collect a bunch of interest on your loan and we don't have any money that, you know, we have to pay to actually make that loan for you. That's not true. We have a huge staff behind the scenes internally with operations that needs to be all paid. We have underwriters, we have processors, we have people in the closing department, people who fund your loan, people who service your loan, all that good stuff. So those are all salaries that we have to pay. And so, for example, Prosperity Home Mortgage, our fees generally are about $1,475. We don't adjust our fees based on your loan amount, which is nice. If you are working even with, let's say, Bank of America or Wells Fargo, they're going to charge those fees too. They have the same costs associated with arranging a loan and giving you a loan. Also, we don't know how long you're going to actually keep that loan and how much interest we are going to collect. You got to remember that from the lender's perspective. So yeah, we have hard costs. Credit report costs money. There's a lot of certifications and all that good stuff. So next up also, that is what's called, I'm sorry, I should backtrack. All of these are called non-recurring closing costs. And then there are recurring closing costs, which I'm going to touch on. So escrow, your hard costs with the lender, and then title and any other like notary fees and things like that are all non-recurring closing costs, meaning they're only going to happen once in the transaction.
Right.
So your next big cost is usually title insurance. And anybody that's going to give you a loan and have a lien against the property is going to require that you have title insurance. That fee is also a function of your purchase price and your loan amount. So what title insurance is essentially is that it's ensuring that the title is transferred free of prior claims of ownership or encumbrances and liens. It's clean when it's transferred to you. And if it's not, and there's something way back in public record, maybe that they missed, it's an insurance policy for you and the seller. So that's your other big closing cost associated.
So with that being said, what do you tell people when they ask you what title is?
Title is, it's title insurance. It's basically an insurance policy ensuring that you are transferred clean title. I mean, how awful would it be to go buy a house and then someone who comes along and says, hey, that's my house. I own that house. Look, I have this deed.
Right.
Well, you know, it's an insurance policy.
Wow, that's like a subject for a whole other video too.
It is, yeah. That and escrow, those are two actually separate videos. But yeah, the title company has title examiners that go in and look through all the transfer history and do their, you know, back end research to make sure that nobody else can come and stake a claim to that property, and that, you know, or there's no debts that that seller had that we don't know about that, you know, could potentially be liens on the property too.
Mind blown. So much.
Yeah. I told you, a lot of moving parts in a transaction.
Absolutely. Keep going. What do we have next?
Yeah.
Points.
So points are another non-recurring closing cost. And actually, if you don't mind, let's touch on what discount points or points. I know that's a word that's tossed around a ton.
Please.
But that could be another non-recurring closing cost depending on what you negotiate with the lender and where you want the rate to be. But I want to touch real quick too on recurring closing costs that you also need to have some money set aside for and consider when you do purchase a home. And those are property taxes, insurance, and interest. So let's say, Joey, I buy your house, okay? And I'm gonna close on the 15th of the month.
Okay.
Well, if you were me and the buyer, would you want to pay your rent or your mortgage payment for the whole month, or would you want it to be prorated for the days that you were in possession and only pay 15 days?
Right, I would hope.
You know,
The 15th.
Yes. So one thing to remember is that interest is always paid in arrears. It's not like rent where it's paid forward. So you are going to have some interest prorations. When you close, escrow will calculate all of that, and it's calculated on a per diem basis. Because it's interest and that's something you're going to pay every month when you have a loan, it's considered a recurring closing cost. And like they always say, death and taxes are the two only things that we're guaranteed in life. You also have property taxes that are prorated, and those are recurring, sadly, twice a year, depending on what county you're in, state you're in. And so those are a prorated amount when escrow balances the file. So that's another recurring closing cost.
And property taxes can be paid either twice a year or can be rolled into the mortgage. Is that correct?
It's true. Now, the lender is still going to pay them generally twice a year on your behalf in most instances when you do opt to roll them into the mortgage payment. And actually, that's another great term. I'm glad you bring that up. It's called an impound account or an escrow account. And it's like a little reserve account that whoever services the loan holds on your behalf. And when those tax bills and then your homeowner's insurance premium, which is another recurring closing cost that's prorated and paid at closing, they calculate what maybe that annual amount or annual premium is, divide by 12, and then that's added to the monthly mortgage payment. I personally love it. I recommend it to all my clients because I don't know about other counties, but at least in LA, property taxes, first installments due in November, late by December, and then the next one comes up quick, due in February, late by April. Like, I don't know, between the holidays and the new year, I'm like, I don't want to get slapped with a huge tax bill twice. I'd rather just know that as part of my monthly payment, I don't have to think about it again and let them manage it for me.
It's true though. My wife and I do the twice a year, and it does seem to come like so fast. Like the next one, like we just wrote a check.
Yeah, and in higher priced areas, it's not a fun bill. So
Great.
yeah.